Hello, today is the 16th of March, another episode of Two Grey Beards. So let's have a look at what happened last week. Last week we had two nasty little surprises from CPI and PPI, which were both about 0.1% higher than expectations. The market was hoping that January was a bit of an aberration and that we'd continue the trend in February, but it wasn't to be. So the market basically next to nothing on the downside in equities and cheapened up quite a bit in bonds. Although we did have some very, very good auctions, didn't we, Andy? We had three pretty damn good auctions in threes, tens, and thirties. The thirties were certainly spectacular, and yet every single one of them went underwater by the end of the day. So the bond market is not liking something. There's something the bond market is very skeptical about. But we shall see, because this week is the big week, isn't it? FOMC, BOJ, Bank of England, Swiss National Bank, all the central banks are taking central stage, and they will tell us what they think is going on.
Absolutely. Yeah, from last week, I look at the auctions and grade them every week. Threes and 30s, which were the bookends of the auctions, were great. 30s, really great. Tens was a pretty bad auction, if I recall. But when you look at all of the bonds, they're all now underwater, which is interesting. The upcoming data from the central banks will likely reflect a hawkish tilt. We're fairly confident, Matt. I think they've basically announced it through the Nikkei newspaper that the BOJ will raise rates to zero from negative and potentially tweak the way they manage the long-term interest rates by dropping yield curve control and replacing it with some sort of more standard quantitative easing. So they'll remain, it's a hike, but they'll remain fairly easy relative to all the other countries. I suspect all the other countries are leaning hawkish.
Yeah, the BOJ really, the market has already adjusted rates ahead of it, and this latest leak from the Nikkei that they are going to abandon the negative interest rate policy is really no surprise, and that is why the yen is really not moving very much. And certainly the yen is an important currency because it's a funding currency. So I can't see this changing very much from the, whatever the BOJ does on Wednesday, I believe Wednesday evening. So we shall see, but I don't expect anything much market moving from the BOJ. The FOMC will be the one that really determines the path of real assets in the future. And let's try and give you some frameworks about how at least we think about what the FOMC might do. At the moment, it seems to be a toss up between whether they move one of the cuts, which they've penciled in for 2024, into 2025. And that seems to be the highest probability that the market is assigning to any kind of move by the Fed. Why would they do that? Why would they move a cut out of 2024 into 2025? What do you think, Andy?
Right. So the move on is in response to, in my view, is in response to data, and they've said they've been data dependent, and it makes sense to tweak the projection, the economic projection, the so-called dot plot, to either leave it the same, which is three cuts, or move to two cuts. Any other outcome is just not realistic. It's going to be one of those two. And why? Well, it's a delaying of the easing that would happen if they were to cut more rapidly. The 2025 is an interesting year as well. As of the moment, they expect to cut 3 points, 175 basis points. And You would think that if they push a cut from 2024, that it will likely happen in 2025. So just a delay. But so far, the market has actually been a little bit more concerned about that and wondering if they just take the cut out completely. Which brings us to 2025 dot and the all important long term interest rate.
Yeah. If they start now unpinning 2026 and the terminal rate, that is really going to have big consequences for the markets, because what they would actually be saying is that they are raising R star. To me, that is terribly unlikely because, let's face it, CPI went all the way very close to 10%, and they kept the long term interest rate constant throughout that period in 2022 and 2023. And for them to now start moving up the terminal rate for 2026 would really mean that they are unpinning something, that they are fundamentally doubting that they can get either inflation down to 2%, or they're saying that R star, which is more probable, has moved higher. In which case you unleash a bout of volatility into all asset markets, bonds and equities, because everything needs to be repriced. We have prepared a little table for you of things that of Fed action and what the likely consequences might be, and we will attach it to this video. But we think the probabilities are that the highest probability is that they slightly raise the 2024 dots and punt them into 2025. If they just start raising things without delaying into 2025, that I think is going to be pretty bearish for assets. What do you think, Andy?
Yeah, I mean, mostly I agree. The question is, and this is about knee jerk versus sort of the way it will ultimately evolve in the days to come. But generally, the markets, all asset markets, bonds, stocks, gold, all assets, have responded when the Fed is dovish, they rally, and when the Fed is hawkish, they sell off. And that's the knee jerk. In the event that the Fed were to raise all three of those rates, the 2024 dot, the 2025 dot, and importantly, the longer term dot, the right answer is that a portfolio of assets should sell off. But I think the long term bonds are the things that, after a knee jerk sell off, after an immediate repricing, actually do the best, because it shows that the Fed is serious about solving inflation. But that can take some time to evolve. And I don't think any short term, it's not bullish for long term bonds, but longer term, it's at least bullish for longer term bonds versus every other asset. So I guess the right answer is we don't have any long-term bonds, modest in our VWAP, but we don't have much long-term bond exposure. So for us, it's about managing the rest of our assets through a period of time where the Fed could get either do nothing, and the December dot plot is repeated this time, or some level of hawkishness. And so we don't know how it's going to come out. We're going to have to look at those numbers, but we'll, as Nick mentioned, we'll have a chart that gives you all the possibilities
and the likely outcomes.
Possibilities, yeah, and what to do about that.
Yeah, and we shall certainly send you an email, and possibly more than one, as a result of what we see the Fed has done, and maybe other central banks, and then the market response, because we don't know how, well, we think we know how the markets will respond, but they are almost extremely likely to overreact, both on the upside and the downside. So we want you to be prepared to receive possibly several emails next week after the reactions of the markets, because we might want to lighten up a whole load of positions if the markets overreact to the upside in equities, for example. If there is no move from the Fed and the markets go euphoric, that actually would be a great opportunity to lighten up on certain assets.
Yeah. So before the Fed which is Wednesday, on Monday night, we have to mention, because it's really generated all of the performance of equities lately, NVIDIA will be presenting, Jensen Huang will be presenting a AI hype speech at 4 p.m. Eastern Time on Monday. And so the market won't react on Monday. On Tuesday, it'll react. It's possible that some over or under reaction on that would also cause us to send you an email about equities. But that's how the week will play out.
Yeah, absolutely. So be prepared for possibly several emails now that our QQQ options have expired worthless. But I'll mention all that in my next little segment.
Sounds great, Nick.
See you next week. The portfolio was ever so slightly down for the week because it was a funny week, really, in which bonds underperformed by quite a lot. In any case, no disaster. Our QQQ options have expired, so no change in allocations to QQQ. As mentioned, should this rally a lot, we will probably send you an email on Tuesday morning to lighten up before the Fed is on deck. And I've written it all down in the order entry. No firm orders today, but be prepared for several emails. You will certainly get one after the FOMC, where we'll give you our immediate reaction to things and what to look out for. But in any case, be prepared for several emails next week should it be necessary. And please make sure that you register at that address. Otherwise, everything is updated. You have the broker statements updated and the monthly performance and the yearly performance so far. And again, absolutely no change. These are the rough allocations, in fact, the precise allocations at the moment. And I think they are likely to change next week, so please stand by your emails, as they say. Thank you very much indeed, and speak to you next week.